Hello everyone, my name is Dan Bossie, president of AgResource Company, coming to you here from Chicago. Joining me is Bill Tierney, our director of research here at AgResource. We have seen a market meltdown, Bill, the macro markets that are just imploding, if you will. Key banks and the IMF and World Bank came out and suggested that there was $730 billion, that has left the emerging economies. Also suggestions that a lot of these emerging economies that have borrowed debt have done so in dollar-denominated terms. That has to be paid back. Of course, the dollar's been rallying. It's costing everybody dearly. And when you compound that with sliding crude oil prices, and you think about what that means for Saudi Arabia or people in the Middle East or other oil producers, such as maybe Norway, this has big impacts in the world agricultural and to a more degree, of course, financial markets.
Well, certainly, I would say since the 2008-09 global recession, there's been a trend in agricultural analysis to start off your market commentary by talking about macro developments. What that leads the casual reader to believe is that agricultural markets are driven almost entirely by macro developments. But when you test that hypothesis, the data is much less clear and in some cases totally inconclusive. One of the things that I did back in 08-09 and in several years since then is I looked at the changes between milk prices, corn prices, wheat prices, and soybean prices, and some of the major macro drivers that you just mentioned. One of them was the value of the dollar index. The other one was the S&P 500 for a measure of what's happening in equity markets. And the last one was crude oil prices. Of those, the only one that I could find a consistent relationship that was statistically significant was the relationship between crude oil prices and soy oil prices. Almost everything else seemed to suggest that there are not strong relationships between changes in agricultural commodity prices and changes in these major macro drivers. So while it's got a lot of people's attention, unless you can show that demand is going to be greatly impacted by these variables, and therefore people will have less income to spend on agricultural products, it's highly unlikely that you can show that there's going to be an impact in the agricultural markets.
Bill, that would suggest that a lot of the people are invested in the stock market, and the stock market going down would have an impact on their savings or disposable income, unlikely for the vast majority of the world.
Well, here again, for the vast majority of the world, the price elasticity of demand for agricultural products is very low. In other words, you raise the price, you lower the price, you're not going to change consumption. And for many of the OECD countries, many of the countries that you mentioned, the European economies, even the Russian economy, these are relatively high-income countries. So if you lower their incomes by imagining a recession, a global recession like we had in 08-09, you can't find a decline in consumption. So except for maybe livestock products in countries that have moderate to low incomes, basic grain consumption is not going to change. Maybe livestock consumption will change, again, under the assumption of a global recession. So clearly it's something that's captured the market's attention. There's a lot of talk given to it, but when you try to test these, again, going back to 08-09, when we did have a global recession, try to find or prove that there was an impact on demand. It's just that so far I haven't been able to find an impact on demand, except in the case of livestock, and except in the case of relatively low and moderate income countries, and that's only under a scenario of a global recession. And I don't think we're there yet.
No, I am complete agreement. There's no global recession as we see it today, though there will be some stress factors that I think the marketplace, broadly speaking, is looking at. That being said, we know there is some impact on supply because farmers in different parts of the world respond, of course, to currency and supply. Let me just use the example today of Russia, where farmers, whether it's corn or wheat, are looking at their highest prices on record record because the Russian ruble is at 82 to 1 because of crude oil's fall. And so this will impact the Russian farmer as he looks forward to the next planting season. I guess that's where we tend to agree, is that it's a supply-denominated kind of factor going forward as opposed to demand-denominated.
We've talked about in the past what the impact of changing currency rates is. And in the case of the United States, anytime the dollar goes up, any export commodity gets more expensive. Similarly, anytime the dollar goes up for countries whose currency has not gone up equal to the dollar, like the Chinese yuan, the European euro, the Russian ruble, the Korean currency, any country that imports dollar-denominated products sees a price increase. And so that hurts demand. So, but here again, you have to understand that the price elasticity of demand is very, very low for many of the importing countries. So even if you postulate that the dollar has gone up 10% against the yuan, therefore in yuan, soybeans are 10% more expensive. Therefore, the Chinese are going to consume less, and then you see that Chinese consumption has actually gone up. It's because the price elasticity of demand is relatively low, and there are other factors that are driving up and are fully expected to increase China's soybean imports this year. So you can't give disproportionate weight to a single factor like currency. But globally, what's going to be the impact of higher value of the dollar? It's going to hurt U.S. export competitiveness, and it's going to increase export competitiveness of our major export competitors. It's not just Russia, it's Canada, whose currency has been impacted. Canada is a major competitor for wheat exports, also oilseeds. Australia's currency has been impacted mainly because of other commodities, not just oil. It's something that's not good for U.S. exports. It's something that improves export competitiveness of major competitors, and it could stimulate. We could actually see a stimulus of their own production.
So I've only got another minute left here. So world corn demand looks to be improving at this point by vessel counts and some of the analysis we do on a month-to-month and a really week-to-week basis. Mm-hmm. Just give us a quick comment about that.
Well, it's not just corn, it's also soybeans and wheat. If you take a look at the cumulative exports to date of the major exporters, it suggests that USDA's export numbers are perhaps a little bit too low for wheat and for soybeans. But in the case of corn, I just completed the analysis today, USDA may be underestimating global corn demand by anywhere from 7 to 10 million metric tons. Mm. And you say, well, how is that possible? Well, last year, in January, their projection was too low by 10 million metric tons, a little bit more than 10 million. 2 years ago, their export projection in January was too low by 20 million metric tons. So there's certainly a recent track record for the USDA to underestimate. And this year, based on the exports that we've seen to date of the major exporting countries, it looks like, again, that perhaps USDA is underestimating corn exports. Now, we're only 4 months into the marketing year. I'd certainly like to review this conversation 6 months into the marketing year. But to date, it certainly looks like demand is much stronger than the USDA is projecting.
A little bit of good news for our agricultural producers around the world in terms of corn trade. Thank you, Bill, for joining us. My name is Dan Bosse, President of AgResource. Wishing you a good day and hopefully maintaining yourself in these markets. Bye-bye.